Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me for this segment, we have Brandon Pizzuro, Director of Public Investments at Guidestone Capital Management, to discuss why quality tilt should permeate portfolio positioning. Brandon, it's great to have you with us. Welcome to Trade Talks.
Good morning, Jill. Thanks for having me.
You got it. What's your base case for next year?
Sure. Everyone's got an opinion, and we do too, of course. Base case, we're looking between now and the end of next year for a roughly flat to slightly negative year. Probably call it mid single digits down year. And really that's pivoting off of a couple of things. First and foremost, you're getting that earnings decline that everyone's been anticipating, starting to see that roll over. And that's something that we expect to continue into the first half of the year, permeating the entirety of the year for that base case view. You have a lot of margin headwinds that we feel finally come home to roost. Things like input costs, of course, inflation for wages, et cetera. But those things will probably in total get you roughly that flat to slightly negative year.
Do you expect macro to be the driving force?
I think we do. I mean, you can't fight the Fed. You can't fight a lot of the macro. This is a tremendously strong macro week, which we might get into further here. But macro is going to continue to drive next year, especially the first half. We obviously are waiting for a great day when those fundamentals will return and people will begin to continue to concern themselves with those. But until then, you cannot ignore macro. It's been a massive driving force this year, and we expect that to continue.
What about fixed income?
Fixed income's investable again. You know, you heard earlier in the year and even not that far ago that people were saying the 60-40 is dead. I mean, we believe the 60-40 is still alive and well. Increasingly, like I said, fixed income's investable. You have those higher yields that make it attractive again. From a valuation perspective, we feel like we're a bit stretched. There's definitely pockets of fixed income that are interesting, particularly IG credit, MBS, ABS. Those are some areas that you should definitely look to get positioned into.
So how are you positioning overall for 2023?
Yeah, I would say we're still tactically defensive. We want to make sure that we're not trying to be a hero going into next year. I think that's part of the problem when people try to go out the risk curve and try to be too early. That can really certainly bite you. But we're tactically defensive, but certainly looking to re-risk where we can. I think that opportunity to re-risk will come in 2023. Of course, the timing's anyone's guess, but we want to keep our finger over the button to make sure that we don't miss it. We'd rather be just a little too late than rather too early.
Right. What sectors do you see opportunity in?
A couple, for instance, going into that defensive positioning, you have your typicals with staples and healthcare, for instance. But you really need to think about the underlying industries here. So within healthcare, not just broad-based sector, but also getting into medical equipment. We think that's a pretty durable area to be in, one that's typically rewarded, one that's somewhat of an evergreen industry. Also within staples, you have to think about some areas of opportunity there. Again, not just from a broad positioning standpoint, but things like household products that people tend to gravitate towards that they're not going to stop using in the midst of a recession, which again, we also believe there would be a mild recession baked into that 2023 year.
All right, Brandon, we appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thanks for having me.